Welcome, Wealth Builders, to podcast number 82. When investing, discipline is the edge, knowing when to jump in and when to get out. I'm your host, James Marshall, and today we're going to talk about investing. Let me paint you two pictures. Picture one, it's March 2020. The stock market is in a free fall. COVID is spreading. Your portfolio is down 30% in 3 weeks. Every headline is screaming disaster, and the voice in your head says, get out, save what's left. Most people sold. They panic sold. They got out. And 3 months later, the market staged one of the fastest recoveries in history. Anyone who sold locked in massive losses and missed out on one of the greatest wealth building windows of a generation. Picture two, it's late 2021. Crypto is everywhere. Your colleague has just made $60,000 on a coin you've never heard of more than six months ago. Say that over again. Picture two. It's late 2021. Crypto is everywhere. Your colleague just made $60,000 on a coin you've never heard of 6 months ago. Social media is flooding with people showing off gains. It feels like that pull. It feels like you're missing out. Fear of missing out, FOMO. So you jump in at the top and you watch it collapse 70% over the next 18 months. No discipline. Welcome to 100 Wealth Building Secrets. Strike that. No discipline. Welcome to the 100 Wealth Building Secrets podcast. And I am your host, James Marshall. Today, we're unpacking one of the most powerful principles in my book, 100 Wealth Building Secrets. One that applies whether you're investing in the stock market, building a real estate portfolio, growing a business, or all three at once. Secret number 82. When investing in any market, it is important to be disciplined. Know when to jump in and know when to get out. Let's get into it. Discipline is your greatest investing asset. Let's start with a question. And what I want to sit and what I want you to sit with honestly. When you make investing decisions, whether it's a stock purchase, rental property acquisition, a business investment, what is actually driving that decision? Is it a strategy, a written plan with a clear criteria of your every step? Or is it how you feel that week? What the market did yesterday? What someone in your network is talking about? Because here's the truth that most financial media conveniently skips over. The market is not your biggest threat. Your emotions are. Hmm. There's a concept in behavioral finance called the behavior gap. It's the difference between what makes markets actually, say that again. There's a concept in behavioral finance called the behavior gap. It's the difference between what markets actually return over time and what the average investor actually earns over time. Here are the numbers. Over the past 20 years, the S&P 500 has averaged roughly 9 to 10% annually. Solid, historically strong. The average retail investor, studies show, have earned somewhere between 3 and 5% over that same period. Same market, less than half the results. Why? Because the average investor buys high when the excitement is at its peak and sells low when fear takes over. Emotion in, discipline out, wealth loss. Now, I want to speak directly to who's in this room because I know exactly who's listening to this show. You are a forward thinking individual who has built something. You run a business, you own property, you hold a leadership position, you manage teams, clients, budgets, and sometimes you risk everything in a single day. You make high stakes decisions under pressure, professionally, without flinching. And yet, when it comes to investing, even the most accomplished, brilliant person I've worked with will tell me they second guess themselves. They hesitate. They let someone else's noise override their own judgment. Here's what I want you to understand today: the same discipline you use to run your business, the same strategic thinking you apply when you're evaluating a property or making a hiring decision, that is exactly what successful investing requires. You already have the skill set. We're just applying it to a different arena. So, how do you know when to jump in? You need an entry framework. Let's talk about the first side of this coin, knowing when to jump in. And let me be crystal clear up front. This is not about timing the market perfectly. Anyone selling you that promise is selling you a fantasy. Even Warren Buffett would tell you that consistently timing the market is impossible. What we're talking about is strategic entry, putting capital to work based on logic and criteria, not emotion, not hype, not what's trending on financial Twitter. Here are 5 principles to guide every entry decision you make. Principle number 1: have a thesis before you invest, not after. A thesis is your documented reason for making an investment. Before a single dollar moves, you need to be able to answer 3 questions clearly. What am I buying? And what's the real source of its value? It's number 1. Number 2, why do I believe it will grow? What's the opportunity? What's the trend working in my favor? And number 3, what would have to be true for me to be wrong? This is the question most people skip, and it's the most important one. So I'll say it again. What would have to be true for me to be wrong? If you can't answer all 3 before you invest, you're not investing. You're gambling with the ticker symbol attached to it. And listen, you already do this instinctively. Before you sign a purchase agreement for any major purchase like a house, a car, or a boat, you ask, is this a good price for the value? Is this location strong? What happens if the economy declines? That's a thesis. Apply the same rigor to every investment vehicle. Principle number 2: use dollar cost averaging, especially in volatile markets. Now, I've talked about dollar cost averaging in prior podcasts, so you've heard this phrase before. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of the market conditions, every month, every quarter, whatever cadence fits your cash flow. And now that you have mentioned it, I know that I've mentioned it before in past podcasts, but it's worth repeating. This strategy mechanically removes the emotional decision of when to get in. When prices are high, your fixed amount buys fewer units. When prices are low, it buys more. Over time, your average cost smooths out and you stop agonizing over finding the perfect entry point. Dollar cost averaging works. Principle number 3: don't confuse cheap with valuable. This is a trap I see constantly. An investment drops 40%, and suddenly it feels like a deal. But low price alone is not a buying signal. The real question is, why did it drop? Is this a temporary market overcorrection? Or is the underlying business asset or market fundamentally impaired? Water seems to seek its own level every time. A rental property in a neighborhood with declining population, rising vacancy rates, and deteriorating infrastructure isn't a deal because it's 30% below peak. It may just be a problem you're paying to inherit. Dig deeper. Ask harder questions. Cheap and undervalued are two very different things. Principle number 4, pay attention to valuations. Every asset has a price, and every asset has a value. The gap between those two numbers is where opportunity lives. For stocks, look at the price to earnings ratio relative to historical averages. For real estate, look at cap rates relative to your market. For business acquisition, look at EBITDA multiples. When prices are dramatically higher than underlying value, that's a caution flag on new entries. So, if it looks too good to be true, it probably is too good to be true. Principle number 5, be greedy when others are fearful. The best entry point in history has always been during moments of maximum fear. The 2008 financial crisis, March 2020, the regional banking scare of 2023. The people who made generational wealth during those windows had two things: available capital, because they hadn't over leveraged themselves chasing that previous peak, and the discipline to act. When their instincts were screaming at them to hide, they did not hide, they got in. Now, this doesn't mean catching a falling knife with a strategy. Say that again. Now, this doesn't mean catching a falling knife with no strategy. It means your thesis is intact. If the fundamentals are sound and prices have dropped due to panic rather than permanent damage, that fear could be your invitation. Prepare for those moments before they happen. Keep a reserve. Know what you want to own. Have your criteria ready. So when the fear window opens, you're not frozen. You're positioned. In the words of John McKay, dig your well before you're thirsty. Long out of attachment. Wait a minute. Back. How do you know when to get out? The exit framework. Know the other side. And honestly, this is where more wealth is lost than anywhere else. Knowing when to get out. There are two opposite failure modes here. The first is selling too early out of fear, locking in losses during a downturn that was always going to recover. The second is holding too long when you think that something's going to come back. Holding on out of hope or attachment. Writing a great investment all the way back down because you can't pull the trigger. Both are discipline failures. Both are preventable. Here are your 5 exit principles. Exit principle number 1. Decide your exit before you enter. Decide your exit before you enter. This is the single biggest habit that separates professional investors from everyone else. Before you buy anything, a stock, a rental property, a business stake, you decide in advance under what conditions will I exit this investment. Maybe it's a target return. Maybe it's a specific price level. Maybe it's when the property reaches a certain equity position and you want to do a 1035 exchange into something larger. Maybe it's when the thesis breaks. Whatever it is, write it down before you're emotionally invested in the outcome. Sounds like having a plan, right? Because once you're in, the mind starts rationalizing. You start telling yourself stories about why you should hold longer. Preset rules cut through the noise. Exit principle number 2: sell when the thesis breaks, not when the price drops. A price drop alone is not a sell signal. Markets fluctuate, prices move on sentiment, news cycles, interest rate speculation, and 1,000 other variables that have nothing to do with what you actually own. Ask yourself, has anything fundamentally changed about why I made this investment? If the fundamentals are still strong, if your rental property is still healthy, if the company still has its competitive edge, if the business you invested in it still has sound leadership and growth prospects, then a temporary price drop is not a reason to exit. It may be a reason to buy or add a stronger position. But if the thesis is broken, leadership proved dishonest, the market shifted against you, the asset is deteriorating, then you exit. Not because of price, but because the reason you owned it no longer exists. Exit principle number 3. Have you, say that again, exit principle number 3. Have a stop loss strategy and honor it. A stop loss is a preset threshold, a point at which you exit a position to prevent further loss. Think of it as a circuit breaker for your portfolio. Stop losses aren't perfect. Sometimes you'll get shaken out of a position that recovers. That's the trade off. But for most investors, making busy lives, boom, boom. But for most investors managing busy lives and businesses, having a hard rule protects you from the scenario where a 20% loss becomes a 50% loss because you kept hoping it will come back. Protecting capital is the first rule of building wealth. You can't compound what you don't have. And that's the truth. Exit principle number 4. Take profits strategically. Don't let greed ride the whole cycle. This one is especially relevant for real estate investors and business owners who've built significant equity in a single asset. When one investment has grown to dominate your portfolio, that concentration creates risk. If that asset reverses, it can erase years of gains across everything else. Periodically taking profits, harvesting equity, rebalancing, diversifying is not weakness, it's wealth preservation. It's how you lock in generational progress rather than gambling it on a single outcome. A simple rule: if any single position represents more than 20 to 25% of your total net worth, that's a conversation worth having with your advisor about risk management. In other words, you're lopsided. You're too overweighted in that position. Exit principle number 5. Watch for the signs of a market top. Watch for the signs of a market top. Not to panic, but to prepare. There are patterns that historically precede major market peaks. Now, these aren't guarantees. Nothing in the markets is. But The signals are worth watching. Extreme valuations stretch far above historical averages. Widespread public euphoria when people who've never invested before are suddenly experts. Rapid price acceleration, no underlying fundamental justification. Heavy leverage across the system. People and institutions borrowing aggressively to chase these returns. And perhaps most dangerously, the narrative that this time is different. Sounds familiar? I think we're experiencing a little bit of that right now with AI investing. So, I mean, it's worth thinking about and talking about and considering when you look at your portfolio. When you see several of these stacking up together, that's not a reason to sell everything and go to cash. But it's a reason to tighten your exit rules, reduce your entries, build your reserves, and protect what you've built. Let me give you a framework I love for exit decisions. It's called asymmetric risk. Asymmetric risk. Before staying in any position, ask yourself, what is my realistic upside from here? And what is my realistic downside? If you're sitting on an 80% gain and you believe there's another 10% upside, but 40% downside risk if the market turns, that math is asymptomatic. Um, um, Asymmetric. That math is asymptomatic against you. Take some off the table. Take some of that money off the table. Ring the cash register. If you're early in a position with a strong thesis and you see 100% upside potential against 15% downside risk, that math is asymptomatic. That math is asymptomatic in your favor. Stay in, maybe add to the position. You got in low. There's a lot more room to grow and very little risk to go down. That's a buy signal. Strip the emotion out. Run the math. The numbers will usually tell you what to do. So, what is the discipline habits that make this real? Frameworks are only valuable if you actually use them. So, let's talk about the habits that turn principles into everyday practice. Habit number one, write down your investment plan and review it at least quarterly. Write down your investment plan and review it at least quarterly. I'm going to say this plainly. If your investment strategy exists only in your head, it's not a strategy. It's a collection of intentions that will evaporate the moment the market gets scary. Your written plan should cover your goals, your time horizon, your target allocation across asset classes, your entire criteria, your exit criteria, and your rebalancing rules. When the market drops 15% and the news is alarming, you pull out the plan. You don't react to the headlines. You check the plan. Habit number two, build a watch list and set price alerts. Don't chase. The investors I respect most don't react to the market, they prepare for the market. They maintain a list of assets they want to own at the right price. Real estate markets, they're watching. Stocks on their radar, business acquisition opportunities, they're tracking. And they set alerts so that when prices reach their targets, they're ready to move decisively, calmly, because the homework was already done. Chasing is reaction, preparing is strategic, and strategic is how you build wealth. Habit number three, separate your news consumption from your decision making. The financial media is not in the business of making you wealthy. It is in the business of keeping you watching. Fear drives clicks. Euphoria drives clicks. Nuance does not. Stay informed. Absolutely. You must stay informed. But institute this rule for yourself. I would not make a significant investment decision within 24 to 48 hours of consuming alarming financial news. Let it settle. Sleep on it. Run it against your written plan. If the thesis still holds in 48 hours, act. If it was just noise, you'll be glad you waited. Habit number 4, have an accountable partner. Well, say it over again. Habit number 4, have an accountable partner and be intentional about your advisory relationship. One of the most underrated wealth building tools is having someone to pressure test your decision with you. A trusted advisor, a business partner, a peer in your network who is always building wealth and will give you honest feedback, not just tell you what you want to hear. Here's something I see particularly in high achieving women, a tendency, saying it again. Here's something I see particularly in high achieving women, a tendency to go it alone, to not want to appear uncertain, to make the decision quietly and carry the weight of it all solo. I want to challenge that. The wealthiest people I know, men and women, have teams. They have advisors they trust, peers they consult, and accountability structures they've built intentionally. Your financial advisor should be more than a portfolio manager. They should be a thought partner, someone who helps you stay disciplined when emotion is pulling you off course, someone who challenges your assumptions and helps you see around the corners. Say that over again. Your financial advisor should be more than a portfolio manager. They should be a thought partner, someone who helps you stay disciplined when emotion is pulling you off course, someone who challenges your assumptions and helps you see around corners. If you don't have that kind of relationship with the financial professional yet, that's a gap worth closing. Habit number 5. Review your re- Habit number 5. Review your decisions, both the wins and the losses, without ego. Emphasis on without ego. After every significant investment decision, take 15 minutes and debrief yourself honestly. Did I follow my plan? Was this decision driven by data or by emotion? What would I do differently with the benefit of hindsight? What would I do differently with the benefit of hindsight? The investor who improves over time, who compound not just money but wisdom, are the ones who treat every portfolio like a performance they're always refining, not with self criticism, but with honest assessment and a commitment to getting sharper, getting sharper. I want to take a moment and acknowledge something directly. Some of you listening have been burned. You got in at the wrong time. You trusted the wrong person. You made an emotional decision during a volatile stretch and it cost you. It cost you big. Or it cost you little. It still cost you. You lost money. And I want you to hear this clearly. This part of the journey, every serious investor, everyone, has losses in their history. What separates the wealth builders from the people who give up is what they do with those lessons. Discipline is a skill, it's learnable, it's improvable, and it gets stronger every time you choose the plan over your panic. It gets stronger every time you choose your plan over your panic. That's what this podcast here. That's what this podcast is here to help you build. And it all starts with a plan. So until next time, keep building wealth. Peace.